Welcome to this explainer. Today we're tearing down the absolute market panic surrounding Dick's Sporting Goods to find out if it's a dangerous value trap or a once-in-a-generation buying opportunity. Let's get right into it.
Okay, so if you still think of Dick's as just that local store where you go to grab some basketballs and a pair of cleats, you really need to update your mental model. They've totally transformed into this broad, multi-brand experiential retail empire. We're talking about the massive Dick's House of Sport, Golf Galaxy, their digital sports platform GameChanger, and crucially, their recent acquisition of the Foot Locker business, which brought brands like Champ Sports and Atmos right under their umbrella. This diversification is incredibly important because it essentially insulates their broader business from seasonal swings in any one specific category. Basically, they've turned themselves into a year-round destination for athletes of all levels.
Now, when you compare their highly successful legacy business to that recent Foot Locker acquisition, the difference in scale is actually staggering. In fiscal 2025, they pulled in over $17 billion in total revenue. And as you can see, the core Dick's business remains the absolute workhorse here, driving roughly 82% of that revenue. The newly integrated Foot Locker business makes up the remaining 18%. But here's the crazy part. As we unpack this financial picture, you're going to see that this 18% slice is making a wildly disproportionate amount of noise, and it is completely dictating the stock price right now.
Through that Foot Locker deal, they essentially transformed their footprint overnight. They went from a very US-centric brand to operating across roughly 20 countries globally. I mean, they added over 1,600 North American stores and nearly 700 international locations in a blink. So we're now looking at a combined company operating 3,195 physical locations worldwide. That is an absolutely massive physical footprint. But it also brings some seriously complex logistical challenges. Managing supply chains, figuring out regional consumer preferences, handling international real estate leases at this scale, it requires an absolute masterclass in operational efficiency.
So why does having nearly 3,200 stores actually matter? Well, because their real moat isn't just putting a pair of shoes on a shelf. It's their massive scale, their interactive house of sport experiences, and these unmatched brand distribution relationships that smaller retailers literally cannot touch. When you have this many stores, your purchasing power is off the charts. Plus, their physical network lets athletes come in, test equipment, return items seamlessly, and genuinely experience the product. They are leaning so heavily into experiential retail right now. Think about walking into a store and using a golf simulator to physically test out a new Callaway driver on a virtual course before dropping $500, or stepping into a batting cage to test a composite baseball bat. Because they have the scale and credibility, top brands absolutely need Dick's to distribute their premium products to a captive audience. But I want you to lock this single percentage into your risk models right now, 31. Nike represented roughly 31% of DKS merchandise purchases in fiscal 2025. That is a massive supplier concentration. Now sure, having top-tier brand relationships is a huge strength, but relying on one single vendor for nearly a third of your merchandise, that's a structural vulnerability. From a pure risk management standpoint, if Nike drops the ball on product innovation, or if they decide to shift heavily to direct-to-consumer sales, Dick's is going to feel that pain instantly. It introduces this huge variable that is completely outside of management's control.
And honestly, that structural vulnerability perfectly sets the stage for the stock's recent, frankly brutal 20% plus collapse. We really need to talk about the Q2 earnings crash, because this is where the investment thesis gets super complicated and potentially very lucrative for those who structure their approach the right way. Something clearly broke in the quarterly narrative here, and it caused a fundamental shift in market sentiment. It basically dropped a bomb on the market. Management walked their full-year adjusted earnings expectations down from a really healthy $13.50 to $14.50 range, all the way down to a projected $11 to $12 per share. And listen, when a mature retailer cuts earnings guidance this sharply, institutions don't just trim their positions a little bit, they violently reprice the entire asset. Sudden, steep downward revisions create extreme uncertainty about where the bottom actually is. Portfolio managers absolutely hate uncertainty, so they liquidate first and ask questions later. That's exactly what triggered this severe drop straight down into the 130s.
So to figure out where the absolute floor is for this stock, we have to isolate the struggling Foot Locker division from the incredibly resilient core Dick's engine. The contrast here is just stark. The core Dick's business actually grew 4.9%. For a mature retailer navigating a really cautious consumer environment right now, nearly 5% organic growth is exceptionally strong. But on the flip side, the Foot Locker segment contracted by 3.6%. We basically have a tale of two entirely different businesses operating under one roof, moving in completely opposite directions.
Right now, Foot Locker is acting like a massive heavy anchor. It's just dragging down their consolidated margins due to excess industry inventory and some really painful liquidations. The entire sneaker industry is totally flooded with product right now, and consumer tastes are rapidly shifting away from legacy retro styles toward new emerging performance brands. To move this absolute mountain of inventory, retailers are being forced into these aggressive promotional discounts. And the financial damage here is very real. Dick's had to record a severe $217.9 million inventory write-down, and the Foot Locker segment actually generated a $52.2 million loss in fiscal 2025. This isn't just a hiccup, it's a highly detrimental integration problem that they have to triage immediately.
And this dynamic right here is exactly why I'm telling you to be cautious. Heavy capital spending for integration and building out new stores has severely compressed their normalized free cash flow from over $1.3 billion down to roughly $400 million. Now, don't get me wrong, the business absolutely remains cash generative, but the trajectory of this cash flow profile is definitely concerning. They're sinking heavy amounts of capital into integrating that Foot Locker infrastructure, building out those amazing high-end House of Sport locations, and upgrading their entire supply chain. So while the stock might look pretty cheap on a purely earnings basis, the actual free cash the business is throwing off to reinvest or return to shareholders has dropped off a cliff.
But wait, because here's the thing. All this market panic, it's completely blinding investors to some incredibly valuable hidden digital assets. Things like the GameChanger platform and a highly profitable retail media network. They own digital assets that traditional brick-and-mortar retailers would literally kill for. GameChanger is this wildly popular youth sports app that gives Dick's a direct digital relationship with millions of young athletes and their parents before they ever even step foot in a store. Then, you look at their retail media network. This lets them charge brands for premium advertising and sponsored product placement. It's a high-margin revenue stream that drops almost entirely to the bottom line. It functions way more like a tech business than a retail one. Add to that the fact that they're actively rolling out AI, like conversational agents to optimize inventory forecasting and dynamic pricing, and you have these powerful, under-the-radar growth catalysts that Wall Street is currently valuing at basically zero.
So what's the silver lining for us as retail investors? It's the massive valuation reset. Look, DKS was absolutely not cheap at $240, but sitting here at 11.7 times forward earnings, the risk-reward ratio shifts dramatically in our favor. Before this severe earnings reset, the stock was trading at a really lofty 21 times earnings. The market was essentially pricing this thing for absolute perfection, leaving zero room for execution errors. But after the plunge, sitting down around the $134 level, you're paying less than 12 times forward earnings. The market has completely stripped out that premium valuation, which gives prudent investors a much wider margin of safety to start initiating a position. When we actually map out the floor and the ceiling for this stock, 3 clear scenarios jump out from the analysis. If Foot Locker remains a structural drag and margins stay depressed, that's our bear case, fair value sits somewhere between $95 and $115. Meaning, yes, there is still very real downside risk from current levels. But let's look at the base case. If the core Dick's business just keeps compounding like it has been, and Foot Locker merely stops the bleeding and stabilizes, this stock has a substantial runway back toward that $200 level. And if management pulls off the turnaround flawlessly and realizes all those anticipated synergies, that bull case suggests an intrinsic value upwards of $230 to $275 over the long haul.
Now, because we're dealing with a fundamental earnings reset and honestly a really ugly technical chart showing extreme oversold conditions, doing a lump sum buy right now is incredibly dangerous. This is your classic falling knife scenario. Just because a stock dropped 25% does not guarantee you're going to get an immediate bounce. Human psychology always tempts us to just buy the dip all at once, hoping for that rapid V-shaped recovery. But you have to remember, the market is currently digesting a fundamental shift in the company's long-term earnings power. Going all in right now just exposes your portfolio to unnecessary downside volatility if the Foot Locker situation gets any uglier before it gets better.
Instead, I want to walk you through a 4-step staged accumulation strategy. This protects your capital if the Foot Locker turnaround fails, while still making sure you capture the upside if the core compounding engine prevails. Think of it as systematically scaling into the uncertainty. You take a conservative 25% starter position right here in this current panic zone of $130 to $140. Then, if macroeconomic conditions actually worsen and the asset drops further, you still have dry powder reserved to buy another 25% at $115 to $125, and your ultimate deep value tranche at $100 to $110. You only deploy that final 25% if the stock actually proves the turnaround is working and reclaims that $150 level. It is a highly disciplined, risk-averse way to play a really volatile setup.
So ultimately, your decision to allocate capital to this name hinges entirely on this one final question.
Can management fix Foot Locker in time, or is it going to permanently fracture the Dick's retail empire? If you believe that core Dick's engine is so fundamentally strong that it will buy management enough time to fix their massive sneaker problem, then today's panic valuation is an incredibly compelling setup. But if you think Foot Locker is structurally broken in a totally saturated market, well, then this might just be a value trap waiting to spring. Think really carefully about where you stand on that dynamic before you put a single dollar of your capital